Hey, this is Arthur Hill here, Senior Technical Analyst with StockCharts.com. Thanks for tuning in to On Trend, the show designed to keep you on the right side of the trend. So basically we have small caps extending lower. We're going to look at those in detail. We got some 90% down days in finance and healthcare, and some key ETFs are failing at the 200-day SMAs. Then we're going to show you some bullish consolidations in the bond ETFs and how to scan for outliers. So we're going to start off with a chart list view in summary format because I want to see where the selling pressure was the most intense yesterday. So I've got the 80% indicators for the 3 Dow averages, and I've got the 80% indicators for some major indexes, and then below the sectors. And then on the right, you can see the close for the 80% indicators. And I really don't need these other columns here, so I'm just going to remove them. It's just a personal choice. The less there is on the chart, the more you can focus on what matters. So when we look at the 80% indicators, which measure the number of advances less the number of declines divided by the total issues. So it's like net advancing stocks as a percentage of the total issues. So the further negative it is, the more decliners you had relative to the number of stocks in the index. And so when we start off and we look at these Dow components here, you can see the Dow Utilities was actually positive. So utilities held up quite well yesterday. And then when we look at these indexes, we can see that 2 stand out. Mid caps had minus 80%, and small caps SML had minus 83%. So heavy selling in small caps. Then we go a little further down, we can see gold miners minus 92%. So gold miners were hit quite hard. And I'm going to scroll down so this chart goes just above the bottom of the page there. And then when we look at these sectors, 2 sectors stand out for selling pressure: finance and healthcare. Both of them had minus 90% days. So they were basically throwing out the baby with the bathwater on finance and healthcare. Now, this could mean we have a short-term oversold situation, but I personally don't like 90% down days because you look back to early December, which we'll show in a minute here, the decline started with a 90% down day in small caps. And then if we look further down, the other sector that got clobbered was technology. All right, the only one that had more than 70%, minus 70% on 80% was technology. So these 3 are 3 of the big 6 sectors, and they bore the brunt of the selling pressure, and that is negative. And you can see the only sector that was positive was utilities. So utilities continue to attract buying. So here's a chart that shows you 80% bars, the histograms for the S&P 500, S&P Mid Cap 400, and S&P Small Cap 600. And I've got lines at plus 70% above, and then at minus 70% and minus 90% just for reference below. I personally like to use this minus 70% level because I think it is strong enough buying or selling pressure to take notice. And if you look at the S&P 500 80% indicator, you can see that it has not been below minus 70% since December 24th there. And then we got that plus 70% reading to kick off the current advance. But if you notice, buying pressure has been waning, but that's usually not a big deal as long as selling pressure remains contained, and then selling pressure broke down. But we didn't go below minus 70%, but it is the most selling pressure since January 22nd there. Now, if we look at mid caps, we can see we've had 2 pretty strong days of selling pressure in the last couple of weeks, because you can see 80% move below minus 50% and then below minus 70. And that is the deepest reading since the 24th. So the most selling pressure since the 24th. And then we look at small caps, we went below minus 70%. And again, the most selling pressure since early December, actually. So a lot of selling pressure in small caps. And if you see this red line here, that is the December peak there when we declined. And we had that almost a minus 90% down day in the S&P 500, a 90% down day in mid caps, and a 90% down day in small caps. So serious selling pressure that kicked that off. So this selling pressure that we're getting here could suggest that we're going to get that long-awaited corrective period. So the other indicator that I was following is the percentage of stocks above the 20-day EMA. And again, we've got it for the S&P 500, S&P Mid-Cap 400, S&P Small Cap 600. And for good measure, I threw in the NASDAQ 100. And you can see that small caps broke down first with that move below 70%. And that happened last week. And then mid caps 2 days ago. And then large caps, the S&P 500 yesterday. So now we have all three below 70%. So that tells you that a lot of stocks have turned down. In fact, if you add them all up, you can say that the majority are below their 20-day EMA. So that suggests that they have turned down and stocks are moving into some sort of short-term downtrend, or which would be a correction or pullback after this massive advance that we've seen. And you can see the NASDAQ 100 move below the day before. So weakness across the board here in these indicators. And then here I've got a chart with the percentage of stocks above the 20-day EMA for the 11 sectors. And I'm going to click this heading there to sort by the heading so I get the strongest at the top and the weakest at the bottom. In other words, the stocks have the fewest components above their 20-day EMAs. And we can see that utilities are holding up the best there. And then as far as the weakest, energy by far. And look at healthcare, big downturn in healthcare. Finance, just 50%. So these three sectors are the weakest sectors in the stock market when you look at the internals there. And there's the S&P 500 for your benchmark. So the ones above are holding up better, but technology is the weakest of the other sectors that are above it. Consumer discretionary is above it, materials, staples. So the fact that I see these three of the big six showing some weakness here is a negative short term at least. So just to recap, I Googled SPY holdings here. There you can see it. And you get a lot of hits, but you need to go to the Fund Family website, which is SPDRs. And there you can see the holdings for the S&P 500 SPDR. And if you click on that holdings link there, you can see the individual holdings. And then you can see the sector allocation for the ETF, which I find very important. And you can see the top 6 sectors there account for like 78% of the ETF. And there you can see the top 3 are technology, healthcare, and financials. And these are 3 of the weakest sectors recently. And you can see just adding these up, this is going to be around 29% and 49%. So 50% of the market is really under pressure over the last few days. So what if we get a normal correction after the big advance we've had? And I'm going to focus on SPY mostly because I think that is the most widely followed ETF. Of course, the S&P 500 is the most widely followed benchmark for U.S. stocks. Keep in mind we had about a 16% decline and we've had around a 20% advance. And during that 20% advance, we had very minimal weakness. And so it's very natural to get either a trading range or a correction or a combination of the two. And so how do we estimate where a correction might extend? Well, 2 things we can look at. We can look for a potential support zone. So I see, support here from these lows in that 262 area. And then we've got this consolidation in that area. And then you run a retracement from this low to this high. And you can see the 38% retracement is there. So, the first area to watch is going to be this 265 area, give or take 3-5 points. It's a rough estimate. Predictions are very rough as far as, you can't just pinpoint a level and expect it to turn on a dime. But I would suggest in this 265, 268 area might be the first area to watch for support. And if we look at RSI, maybe in this 40 to 50 zone, but I have a feeling that, if SPY did correct down to 265, RSI would go below that zone. So we'd have to reassess then. But, clearly there's support here from October, November lows, a little bit of a firmness in December, and then this consolidation. So that's as good a point as any to look for support. Now we look at QQQ, and it is holding up the best of the major index ETFs. You can see it's barely pulled back over the last couple of days, and it remains above this support zone. So if QQQ corrected, you can see, it's not as clean cut here. You broke below that level and then you tested it. So you got some sort of a zone. You got this consolidation here. So, maybe this 163, 165 area for QQQ. And then if you look at IWM, this chart, look at the decline over the last 3 days in IWM. Clearly, money was moving out of the higher beta end of the market and moving out of the higher risk plays like small caps. And we saw that, as I showed on Tuesday, some of the high flying stocks that got hit really hard. And if you look at IWM, it did not really break above these highs here from October, November, and, it broke above the December high, but it didn't get above this prior consolidation on a closing basis. You got selling pressure there below 160, selling pressure 3 days ago, and then the biggest selling pressure yesterday with that sharp decline. So IWM, could retrace back to that 146, 148 area is a rough estimate to watch for IWM. So I'm noticing that some key ETFs have failed at their 200-day moving averages and broken below their 20-day moving averages. Now, I did a series on moving averages, and you can see that if you go to the YouTube videos and look through the previous videos. And I tested the 200-day, and I tested different moving average combinations using the major indexes. And for the S&P 500, I found that my preferred combination was the 20-200-day. And I'm not a big believer in, finding a moving average that fits your price and changing your moving average for every price series you have. I like to just pick a pair that makes sense for my time frame and focus on it. So I'm going to work with the 200-day because it's the most popular moving average, and the 20-day, which is around 1 month, an average of 1 month prices. And if you look at home construction ETF ITB, it's been one of the leaders from late December here with this big advance. But, if you look out 6 months, 12 months, it's not one of the leaders. All right, it's not near a 52-week high. In fact, it's not even above the summer high here. The 200-day is still falling, and you came up to the 200-day and you've turned down at the 200-day. So now you're back below the 200-day and the 20-day moving average. So this is quite negative, I think, for home builders, and they could be headed lower. Now, I know RSI got above 70 a couple times, and that shows strong upside momentum. So we'll see what it does here, because this is kind of a test area here where prices, firm before, but I'm not a big believer in support levels for ETFs or indexes that have dozens of moving components. Each component has its own support level. And so those are the ones you really need to watch. I like support levels for individual stocks because it's based on an actual buy and a sell price. Sure, an ETF has a buyer here that might be watching support here, but also the individual stocks affect the value of the ETF. And so if they're moving lower, support isn't going to matter for the ETF. All right, it's what happens to the individual components that really drives the ETF. And so I think if we just take this as simple as possible, we're failing at the 200-day. The 200-day is sloping down, and we're below the 20-day. So it tells me that prices have turned down for ITB housing. So we've got housing and retail turning down below their 200 days and breaking. Well, retail hasn't broken the 20-day, but look at banks. This is the bank ETF, KBE. A lot of big banks in this ETF. You can go to the iShares website if you want to know the holdings here. But if you look at this chart here, there is the falling 200-day moving average. We came up to it with a massive advance, but again, you got to put that advance into perspective. All right, if we look at the percentage change tool here, prior to that advance, we had a 30% decline. So we do have a 32% advance, which is much bigger than that 30% decline, but we're still well below the high before that decline. So now we have a falling 200-day that we're failing at, and we've broken the 20-day. So it looks like the short-term trend is reversing and now down, and the long-term trend is already down. Here's the broker-dealer iShares, and you can see we've got Goldman at the top there. I don't know how much of a broker they are. They're definitely not in the same business as Schwab or Ameritrade or E-Trade, but I would imagine that a lot of individual investors got really spooked there when we had that big market swoon in December, and so that might be affecting business at Schwab and Ameritrade and E-Trade. But, you know, forget the fundamental stuff. When we look at the chart here, what I was working with was the short surge and what looked like a bull flag. And then we got the bull flag breakout, but you can see the same situation. We've got a falling 200-day, and we're failing at that 200-day, and now we're back below the 20-day moving average. So that is a negative combination there. So the flag breakout failed. We failed at the 200-day, and we broke the 20-day. And you have to suggest that the long-term trend is down. So it looks like now the short-term downtrend is in harmony with the long-term downtrend. And regional banks had one of the biggest advances that we saw since late December, up 31%. Of course, it was down 31% before that, and it's still below the August high. So it's had a massive, massive run, but I would imagine we can put some Fibonacci retracements tool, click the annotate, you go over to the left, and there are the Fibonacci retracements. And of course, the million-dollar question is, from what high do you draw it from? You can draw it from the complete high there in June, the biggest high, the highest high, and you can see we're right at a 61.8% retracement failing. So if you're at a 61.8% retracement, the 200-day is falling there, and you're failing and moving below the 20-day, that is not a nice combination for the market, for regional banks especially. And a lot of these groups are doing this. And so at the very least, you would suggest we're going to get a correction of the advance we just had. So we can add some Fibonacci retracements there. And you can see that a 38% retracement carries to 52.29. And so there's a low here, there's kind of a consolidation low there. So, that's your target, your first target for this decline. So biotechs and healthcare stocks are in the news lately because the FDA Commissioner Gottlieb resigned. They're calling it abrupt. I'm not going to read into the tea leaves on what made him resign or what have you. But I would point out that, before he even thought of resigning, the biotech iShares plunged into October and plunged into December. So it can move on its own right. And I think we need to put that news in the background and keep the price in the foreground here. And when I look on the price chart, we're seeing a similar situation, even though IBB got above the 200-day there with that pennant breakout. You can see this gap didn't hold, and now we've failed on the pennant breakout pretty much. So this is telling me that something is not quite right with IBB, regardless of the fundamentals. Maybe it was a knee-jerk reaction. Maybe we'll firm here, but if we move lower again, that's clearly going to be a failed breakout. And you got to be careful with biotechs because they can make some pretty violent moves in a short period of time. So here is XBI, and it had a better pennant breakout. You can see there that this was highlighted. You had the big surge, and then you had the pennant and the pennant breakout. And from the breakout around 82, you got to 92. And I think there's nothing wrong with booking profits ahead of time. You don't have to wait for a downturn all the time, and you don't have to use a trailing stop all the time. A bird in the hand is usually worth two in the bush, especially when you're dealing with biotechs. And so we can see this one's holding up better than the IBB because it's back into this gap zone, and it's right at that 20-day moving average. So it is the stronger of the two, but still, with it back below the 200-day and filling that gap, it doesn't look that positive. And if you look at RSI down below, it didn't get above 70. A lot of stocks and ETFs had RSI moving above 70 with strong momentum, but XBI, that momentum wasn't strong enough to push RSI above 70. Now, I noted that energy was one of the weakest sectors. In fact, I would call it the single weakest sector in the stock market. And then if you look at the oil and gas equipment services, SPDR, it's got to be one of the weakest industry groups because there's the 200-day, and you can see we had a nice bounce, but didn't come close to the 200-day, and RSI did not get above 70. So this bounce has started to reverse here. You can see we're below the 20-day for the second time, and we're below that prior low. So it looks like XES is ready to continue its bigger downtrend. And if we look at XOP, we can see a similar situation here where there's a 200-day, did not even come close to the 200-day, and RSI did not come close to 70. So basically we had this surge, and it peaked in January. And we had a lower high in late January, lower high in February, and now we're turning down. And yeah, I know somebody's going to say, well, there's an inverse head and shoulders pattern. Yeah, well, that may be the case, but I wouldn't look for a bullish reversal pattern when you're that far below the 200-day moving average. Now, if we want a clue on stocks, I do think we need to watch the bond market. And I do think the bond ETFs are in the midst of bullish continuation patterns. And what is a bullish continuation pattern? Well, pretty much the only thing I look for are continuation patterns. All right, I'm looking for a continuation of a move. I'm not looking for a reversal, so to speak. I'm not looking for like big inverse head and shoulders patterns. I'm not looking for double bottoms. I'm not looking for head and shoulders or whatever. I'm really looking for continuation patterns. That's where I focus my energy. And if you look here, we had this big advance and a breakout. All right, we broke above the March, May, August highs. And by the way, you can see I'm using the unadjusted IEF, little underscore before the symbol there. So basically, bullish continuation pattern happens after a big advance, and it's a consolidation or a pullback or a combination of the both. So it could be, a surge. Oh, I still got my rectangle up there. Let me change here. So it could be a surge, and then it could be a falling wedge. All right, but in this instance, it's a surge, and it is a triangle. And yeah, looked like we were breaking down here, but we're bouncing now. And if IEF breaks out here, that's going to signal a continuation higher. And that's going to mean the 10-year is moving lower, the 10-year yield. And yields move lower for one of two reasons, one or both. Either because the economic outlook is dimming, economic growth prospects are dimming, or recession is on the horizon, or if they think there is deflation, disinflation, rates are going to move lower to try and, perk up pricing pressure. Now, I think this pattern becomes really pronounced when we look at the weekly chart for the 7 to 10 year Treasury bond ETF in the top window, and the 10-year Treasury yield in the lower window. So you can see that we had a big decline, 16, 17, 18, and then look what happened in October when the stock market peaked. All right, we had a bottom in Treasuries, we had the big surge in IEF, and the breakout. So this was a bullish development. We're above the rising 40-week moving average. This is a triangle consolidation, and if we get a breakout there, that's going to argue for higher Treasury prices. That's going to mean money is moving into safe havens. And if money moves into safe havens, it's probably not going to be moving into riskier assets like stocks. All right, and if you look at the 10-year Treasury yield, there's the break below 28, which is 2.8%, sideways pattern. And if we break support here, that means the 10-year yield is heading back towards the GASP 2% area, which is 20 on the chart. So just how bad was the decline yesterday, and were there any outliers? And in order to answer that, I was running a scan. It's a very simple scan. You can see the group is the S&P 500, or you could put S&P 400 or 600, and I've got the rate of change is greater than 1. But I'm going to go ahead and change that to the rate of change is less than, minus, and I'm going to put 2. All right, how many stocks out of the stocks in the S&P 500 declined more than 2%? And then I'm going to rank those results by the rate of change. And if I click Run Scan, I'm going to get a new window, and there you can see all the stocks that declined more than 2%, 72. Now, I don't need all these columns here. I don't need the close. I don't need volume, universe. I'll keep the scooter, and I don't need exchange. So you remove those columns and you have a better look at what's going on here. But these are all the stocks. You can click these headings to sort. And so we can see communication services, consumer discretionary, a lot of energy stocks declining over 2%, and a lot of financials and a lot of healthcare stocks. Look at all those healthcare stocks declining over 2%. A lot of selling pressure in healthcare, and then some in technology as well. So 72 stocks means 14.4% of stocks in the S&P 500 were down more than 2%. But now I want to see where the outliers are. Who are the outliers? So I want to look at the rate of change is greater than 1%. And if I run that scan, I'm going to get a different list of charts here. 16 stocks were up more than 1%. Not very many. And I'll just remove the columns that I don't want to see. And there you can see the list. And among them, you can see Netflix, Akamai, Vulcan Materials. So we can put these in a chart list and put them in candle glance format to get a quick look of these charts to see if any of them are interesting. So I've got a chart list called Scan Dump that I put all of my scan results in them. And then I can look at the charts, and I'm going to pick candle glance so I can see 30 charts per page here. So I singled out 4 to watch. There's Kansas City Southern breaking out of a little channel there and above its 200-day. Akamai breaking out of a little pennant just above its 200-day. Netflix is holding the 200-day, and Vulcan Materials is breaking out of a little flag and above its 200-day. All right, so that concludes this edition of On Trend. Thanks very much for tuning in, and have a great day.